rise today to discuss the troubling state of our financial system and the unfinished business of Wall Street reform. I'm here to talk specifically about too big to fail banks. Decades of deregulation, laissez-faire economic policies helped the six largest U.S. banks grow from 18% of gross domestic product only 25 years ago to 68% of gross domestic product in 2009. So from 18% in the mid-1990s to 68% of GDP in 2009. We know what happened next. During the financial crisis, these six mega banks collected $1.2 trillion. Just to understand that figure, if we can, $1.2 trillion is $1,200 billion. And $1 billion is $1,000 million. I mean, so to think these six mega banks collected $1.2 trillion in federal taxpayer-funded support from the Treasury, from the FDIC, from the Federal Reserve. 2 years after we passed Dodd-Frank Wall Street Reform Act, and I supported it because it took many important steps, I'm concerned we're not seeing reform, nearly sufficient enough reform in the financial sector. And as we uncover more and more risky, fraudulent, illegal activities, it seems far too clear, and the American people absolutely see this and believe this, that Wall Street is back to business as usual. Since 2010, we've learned about a number of things. I'm just going to rattle off 7 or 8 significant, serious problems, some illegal, some accusations, some alleging significant systemic problems, all troubling issues that have happened just in the last couple years. Investor lawsuits and SEC enforcement actions over mortgage-backed securities. Municipalities being sold overpriced credit derivatives, bankrupting some of those municipalities, and think of the hardship that causes in those communities. The forging of foreclosure documents and mortgage securities legal documents by 5 of the nation's largest servicers, leading to $25 billion in penalties. $25 billion in penalties for these servicers, forging foreclosure documents and mortgage security legal documents. $25 billion in penalties. The nation's largest bank halting all consumer debt collection lawsuits due to concerns about poorly maintained and inaccurate paperwork. The nation's largest bank losing $5.8 billion so far on large complex derivative trades the regulators either missed or didn't understand or ignored. Suspicions that 16 global banks, including the three largest U.S. banks, manipulated LIBOR, the London Interbank Overnight Rate, that's used as a benchmark for mortgages, for credit cards, for student loans, and even for derivatives. Financial instruments that affect almost everybody in our country. A criminal bid, this is part of this list of problems since 2010, Madam President, a criminal bid rigging trial exposing illegal practices by many Wall Street banks and arranging bids so that banks could underpay for municipal bonds. Former employees of the nation's largest bank alleging the company urged them to steer clients to their own mutual funds because they were more profitable to the bank, even though they paid investors lower returns than other funds, while their clients presumably were trusting them to act in their clients' best interest. The Federal Energy Regulatory Commission investigating whether the biggest U.S. bank manipulated prices in the energy markets, forcing consumers to pay more. A $175 million settlement by the nation's 4th largest bank for discriminatory lending practices in housing markets that include Cleveland and many other cities, and walk through these neighborhoods and see what foreclosures have done to them, see what rigging of, what other behavior on services dysfunction or illegal activities have done to these communities and to these families. And imagine for a moment, put the numbers aside, in the political speech aside, and imagine for a moment you're a parent with a 12 and a 13-year-old daughter, and you've got to sit down with them and say, sorry, honey, we're not, Dad lost his job a few months ago. Now we're losing our home. Where are we going to move, Mom? Well, I don't know. What school am I going to go to? I don't know yet. We've got to imagine the personal hurt and hardship caused by a lot of these things to a whole lot of families in Cleveland and Mansfield and Cincinnati and Dayton. More problems since 2010. Regulators are investigating whether the rate that establishes municipal bond prices is susceptible to manipulation. That's just 1, 2, 3, 4, 5, 6, 7, 8, 9. Those are just 11 examples, all of them huge separately, and in the aggregate, just devastating, potentially, certainly devastating to many individuals, and potentially devastating in a huge way to our economy as a whole. Madam President, the list goes on and on and on. But some experts say we can't, when you talk about potentially these banks forcing them to divest themselves because of their size, some experts say our banks need to compete. You can't, our banks need to compete with the banks in other countries. But then does anyone really believe, do any of these bankers on Wall Street or bankers in my state who have acted, frankly, more responsibly, and the community banks and the credit unions and the regional banks, does anybody really believe that we should follow the European model where never-ending bank bailouts have become the norm? We know the world's largest bank at $2.55 trillion, HSBC, helped launder money for Mexican drug traffickers and Middle Eastern terrorists. And as we know by now, all over the newspapers, the 8th largest bank in the world at $2.4 trillion, Barclays, in the city where the Olympics are being held, was the first bank caught manipulating the LIBOR rate. Not exactly, Madam President, models that we should emulate. Financial reform is supposed to reduce industry concentration. It's supposed to end too big to fail. But the financial sector is even more concentrated now than it was before the financial crisis. And you remember, Madam President, what I said at the outset. In 1995, 18% of GDP, the assets of these banks, of the largest banks, 6 largest banks, was 18% of GDP in 1995. By 2009, it was 68%, and it's even worse today. The top 10 banks' assets, 68% in 2006, now 77% at the end of 2010, and growing, presumably. As a result of mergers during the financial crisis, 3 of the 4 largest mega banks have grown by an average of more than $500 billion. Grown by an average of more than $500 billion. They're in the vicinity of $800 billion and $1 trillion and $1.5 trillion and $2 trillion in assets. The 6 biggest U.S. banks have combined assets that are twice as large as the rest of the top 50 U.S. banks put together. So think about that again. The largest 6 U.S. banks, their assets total this. The 50 next largest U.S. banks, big banks to be sure, hundreds of billions in assets, total even less than the 6 largest. According to Robert Wilmers, the CEO of M&T Bank, the 6 biggest banks in the United States account for 35% of all U.S. deposits, 35% of all U.S. deposits, 53% of U.S. banking assets, 56% of all mortgages, and 93% of trading revenues. This is just 6 banks who wield such immense power in our economy. The message to the markets is clear. These trillion-dollar mega banks, they're too big to manage, they're too big to regulate, and they continue to be too big to fail. We have work to do. For all of its benefits, Dodd-Frank's benefits, including a new consumer protection agency and the oversight of derivatives, Dodd-Frank relies upon regulators to get it right this time. But given their track record, sometimes too close to the people whom they regulate, so-called regulatory capture. Sometimes there just aren't enough of them. Other times they may not have the expertise to be able to chase around some of the smartest, best educated, most experienced banking executives who know how to game the system. And also, we don't, in these regulators, simply, we don't always, as I said, have enough of them. That's why I'm skeptical. That's why we need to go beyond the central provisions of Dodd-Frank that increase capital, that establish living wills, that establish a process for orderly liquidation. Those are all good things, but clearly, I just mentioned these 10 or 11 or 12 problems. Those are just the biggest ones. Clearly, that's not enough. Members of Congress in both political parties agree banks need to have much more capital to cover their losses, much more of a financial capital cushion. We agree that institutions should issue more stock, should restrict dividends, should retain their earnings to build bigger buffers. But while countries like Switzerland are considering 19% capital requirements, a ratio of about 5 to 1, U.S. regulators are staying within the Basel III international capital standards, which FDIC Director Tom Hoenig has said simply will not prevent another financial crisis. There's also a living will process that's intended to make it easier to resolve large, complex institutions. We talked a lot about that on Dodd-Frank. Institutions are supposed to tell regulators how they can be dismantled to protect the financial system as a whole and protect middle America when they get into financial trouble. But the proof will be in the results. So far, regulators have yet to begin a process of simplifying the 6 largest banks that have a combined 14,420 subsidiaries. 6 banks have 14,420 subsidiaries. I mention that number because, Madam President, as you think about every look at these 6 banks, every quantifying number that I try to give, every observation of these 6 banks, every delineation of what these 6 banks do and what they are, bespeaks of this huge, this behemoth that is too big, that are too big to fail, these 6 banks. They're too big to regulate, they're too big to manage, and they're too big to regulate. And there's Title II orderly liquidation authorities. I've heard my colleagues, including my ranking member, my subcommittee, Senator Corker from Tennessee, who co-authored Title II, note that FDIC and Treasury could keep failing banks on life support rather than liquidate them. Is that what we really want when we think too big to fail, too big to manage, too big to regulate? I've talked to regulators who who have privately told me and told Graham Steele and my staff that they believe our banks are still too big to be allowed to fail because the collapse of banks that size potentially could crush the economy. We remember the fear in the voices of some of the top people in the Bush administration when they talked to us in the fall of 2008 about what was happening to our financial system. I don't think we've answered those fears nearly well enough. This is not capitalism the way it should be. It's not right. Some of my colleagues think the answer to too big to fail requires repeal of Dodd-Frank. This is about as silly as it gets, and a return to the same unfettered free market approach that Alan Greenspan championed for decades, and this led us into this mess. Except Alan Greenspan doesn't even think we should have that again, even though he was #1 cheerleader, he and the Wall Street Journal editorial page, for unfettered, unregulated Wall Street. He is, to his credit, and I don't give him credit for much in most of the last 10 years, but to his credit, he has acknowledged that, yes, indeed, he was wrong, that this unfettered, unregulated Wall Street capitalism simply didn't work for our country. He acknowledges doing that again would be a recipe for financial crises and bailouts as far as the eye can see. Instead, we must face the reality that too big to fail is simply too big. We must enact the Safe Banking Act because too big to fail and too big to manage and too big to regulate have become the norm, especially among these large 6 behemoth institutions. Safe Banking Act, my legislation would place reasonable limits on the share of deposits and the volatile non-deposit liabilities that any one institution could take on. It would require the largest financial companies to fund themselves with more of their own shareholders' equity and less leverage. It would put an end to the government's implicit and explicit support for mega banks, specifically the 6 largest Wall Street institutions that, Madam President, as I spelled out earlier, are in a class by themselves. Remember those numbers. The 6 largest banks, 35% of all deposits, 53% of all U.S. banking assets, 56% of all mortgages, 93% of trading revenues. That's 6 institutions that have that kind of power in the economic marketplace, in large part because of actions here. Our legislation would put an end. Under our legislation, regulators and banking leaders in support of our legislation are increasingly voicing support for this bill. Former Federal Reserve Chairman Paul Volcker recently said that the J.P. Morgan episode might be an illustration that these banks are too big to manage. Former FDIC Chairman Sheila Bair says that shareholders and regulators could force banks to break up, but this legislation would be the most direct way to do it. Richard Fisher, president of the Fed of Dallas, James Bullard, president of the Fed in St. Louis, agree that more needs to be done to address the problem of too big to fail banks. Last week, the architect of the too big to fail banking model, former Citigroup CEO Sandy Weil, said that biggest banks should be broken up. Increasingly, this isn't a partisan issue. The ranking member of the Banking Committee, Republican Senator Shelby from Alabama, supported the Safe Banking Act when it was a floor amendment, when it was the Brown-Kaufman floor amendment. I've heard from more and more of my colleagues on both sides of the aisle that they might have voted against it a couple years ago as a floor amendment, but things have gotten worse. The idea is sounding better and better to them. This legislation would protect taxpayers by putting megabank shareholders on the hook for losses, ending bailouts for good. At a time of increasing fiscal constraint, our nation can ill afford to waste precious taxpayer dollars bailing out our largest banks and their recklessness. My legislation would benefit the community banks that are at an unfair competitive disadvantage because mega banks have access to cheaper funding based upon the perception that the government stands behind them. That means studies estimate this support gives mega banks a 70 to 80-point funding advantage. 70 to 80 point basis points means 3/4, 4/5 of a percent on interest advantage, if you will, a subsidy provided by the expectation of taxpayer support of up to $60 billion per year. So if you're one of the 6 big banks, you can borrow money in the capital markets at a lower cost than if you're a community bank in Cary, Ohio, or a community bank in Sandusky, or a mid-sized bank in Columbus or Akron, Ohio, because the market knows that we won't let those 6 biggest banks fail. So their lending is a little less expensive because there's a lot less risk. My legislation benefits investors, as many experts agree that the sum of the parts of the largest mega banks is more valuable than the banks as a whole. So when they begin under our legislation, these 6 mega banks, assets from $800 billion to $2.2 trillion, when they begin to divest themselves, there's a reasonably good chance that they will be worth more in the aggregate than they were in the whole. It will benefit Wall Street families, and it will benefit Main Street families and businesses because increased competition will result in better prices, and fraud will be punished with the full force of the law. Just about the only people who will not benefit from my plan are a few Wall Street executives who frankly have done just fine the last 10 years. We simply cannot wait any longer for regulators to act. Wall Street's been allowed to run wild for years. Their watchdogs are either not up to the job or in some cases complicit in their activities. How many more scandals will it take before we acknowledge that we can't rely on regulators to prevent subprime lending and dangerous derivatives and risky proprietary trading and even fraud and manipulation? Even if they wanted to do the job, and I think they do, the regulators, it would require 70,000 examiners to examine a $1 trillion bank with the same level of scrutiny as a community bank. So the regulation of the community banks is plenty. But when it comes to the 6 largest banks, we're not even close. Again, they're too big to fail. They're too big to manage. Look at what's happened, those examples I gave, and they're too big to regulate. It's simply, we can't rely on the market to fix itself. The 6 largest Wall Street mega banks are essentially an oligopoly and a cartel, making true competition impossible. Mega bank shareholders and creditors have no incentive to end too big to fail because they get paid out when banks are bailed out. They get paid out when banks are bailed out. And banking laws prevent meaningful management shakeups because any hostile takeover effort would require Federal Reserve approval. That's why it's time for Congress to act in the interest of the American public. It's time to restore the public's confidence in our financial markets. It's not there now, to be sure. It's time to put an end to Wall Street welfare and government subsidies. We've seen far too much of that. It's time to enact, Madam President, the Safe Banking Act. I yield the floor.